Hello, Luke Vigu here, your tax assessor. I wanted to take a few minutes and show you how we calculate the tax rate. What I've done is I have brought up my tax rate calculation form. It's actually the municipal valuation return provided to us by the state annually. And there's a lot of information in here. The most important, obviously, being what the tax rate is. The first thing you need to do is fill in the fields that account for taxable value of real estate. And it breaks it down between land and buildings. For this example, I have put 4 billion in for both land and building value. And as I said, this is taxable value of real estate. So this does not include anything exempt, town property, school property, churches, things like that. So you end up with a taxable value for this example, just to keep it simple, of 8 billion. It's pretty close to what our values actually are right now. You then jump over to the tax rate calculation page or tab of this document, and you see that it's already put in our taxable value of real estate. We're not even going to put personal property in for this example, but you'd have your business equipment in here too, adding to this number. So we have a taxable value of $8 billion. You then, step two is to fill in the amount of money that you need to raise for the year. And these numbers are taken directly off of the warrant, where everyone votes on the budget, among other things. And these are really the three main lines that gets broken down into. So you've got your county tax. We have no say in what that is. They tell us what that's going to be. Then you've got your municipal appropriation, which is directly off the warrant, and then your local education appropriation. So for this example, the three of those added together are 71,500,000. So that is your amount of money you have to raise for the year. So you've got a value of 8 billion, you've got an amount to be raised of 71,500,000. You then have some other sources of revenue that we're going to subtract out of the amount that needs to be raised. You always have this municipal revenue sharing. That's another number we have no say in, but it usually pretty well offsets the county tax. So those two are kind of usually about the same. But then we have these other revenues, and you actually vote on these. You see these on usually around Article 17 on the warrant. And I'll read through kind of what those are. It's auto and boat excise, cable TV franchise fees, tower lease revenues, investment interest, road subsidy, parking fines, parking meters, parking stickers, plumbing permits, real estate interest, town clerk fees, transfer station permits. And for the last 2 years, there's actually been another question on the ballot. This past year, it was number 22, where the Board of Select persons asked to move 550,000 from the general fund to help pay things down, pay down the tax rate. So all of that revenue goes in here. So we end up with, for this example, 6.5 million of other revenue sources other than property tax. And you subtract that 6.5 million from your 71,500,000 that you need to operate for the town, you end up with $65 million that we need to raise by property tax. The tax rate is then calculated. It is a simple math problem. You take the 65 million that you need to raise and you divide it by the total value, total taxable value of town, which is 8 billion. When you do that, you're going to get a number. It's right here. It actually is 0.008125. This rounds it. That number is your mill rate. It's your tax rate. And if you take the decimal point and move it over 3 places here, you'd have a tax rate of $8.13. So it really is that simple. It is a very simple math problem where you divide the amount of money you need to raise by the total taxable value, and it gives you that that decimal that is your tax rate. So if you are interested in lowering your individual tax bill, there are only two ways for that to happen. One, your value has to come down while everyone else's stay the same. Another way to put that is your piece of the pie, um, the part of this total value represented by your value has to come down. So if your value comes down, everyone else's stay the same, your tax bill is going to come down. But if everybody's values were to be cut in half, for instance, this number would go up to, or if it was cut in half, this number would come down to 4 billion, and the tax rate would double, and everyone's bills actually stay the same. So if we make market adjustments across the board to everybody, that actually doesn't do anything other than change the tax rate. It doesn't affect any individual tax bill. So your value has to change within the whole in order for your tax bill to change. So that's one way for your bill to come down. The other way is the obvious one, which is to lower the amount of money that needs to be raised. So if we go in here and we change this to, say, 30 million, this now dropped down, amount to be raised 55 million, and the tax rate dropped down to 688. So took 10 million off there, and it lowered the tax rate by about $1.15. So I hope that helps you understand how that works. And